we've seen a significant recovery in the credit markets since the end of March. One of the most significant parts of the recovery has not just been the return or performance of these asset classes, however, the ability of capital management or company managements to access the capital markets, both in the investment grade and the high yield credit space. We have seen new issuance from the investment grade space of $1.6 trillion through the end of September. And we've seen $388 billion of new issuance in the high yield space. Both of these numbers are up over 65% year on year. Now, early on in the recovery, in the April through June timeframe, we were seeing much of this going to bolstering the balance sheet and providing liquidity runway for these companies that really didn't know what the future brought or how long the pandemic was going to keep the economy in a weaker spot. However, as we got into the July through September timeframe, we began to see many of these companies not just bolster the balance sheet, but take out near-term maturities and extend that maturity profile. So where we are today, we have companies both in the investment grade and the high yield space with significant amounts of liquidity, higher than it was prior to COVID hitting, in addition to a lower maturity profile. And what this has done is reduce the risk of investment grade companies to fall into the high yield space, referred to as fallen angels, or companies within high yield to see an increase in defaults. Many of the major credit analysts out there have actually more recently taken down their default forecasts as opposed to seeing them increase going forward. What we're seeing is balance sheets that are actually in slightly better shape than they were before. This should shape up well for an environment going forward as we hopefully emerge and begin to get the economy back on the road again. We began to see that in the third quarter earnings, where we actually began to see improvement from the second quarter and expect that to continue into 2021. With healthier balance sheets, improved corporate earnings, and a Fed that remains accommodative, we would expect spread levels to stay relatively stable or even tighten slightly from here as we look into the 2021 timeframe. We have also experienced this type of an environment in the past. If we look back to the 2008-2009 timeframe, the early 2000s, or even the early to mid 1990s, we've seen periods where spreads widened out, contracted sharply, and then you had a period of relatively stable spreads and positive returns for both the investment grade corporate and high yield corporate world. We would expect we're entering into a similar phase currently for a stable spread environment with positive returns for both investment grade corporates as well as high yield corporates going into 2021. We expect a coupon-like type environment with relatively stable spreads as we look forward.
安聯投資